Hey people, I welcome you all to Caroline's Online Academy, and we are in this series of videos in which we're solving the previous year board examination questions that were asked from the chapter Accounting for Share Capital. We had earlier classified the problems into four types, that is the 1 mark questions, and then the schedule for share capital preparation questions, and then the forfeiture and reissue questions. And the last category was pro rata, forfeiture, and reissue. All of that being tested in one problem as a 6 mark problem. Earlier, it was tested as an 8 mark problem in the previous board examinations. So today, what we're going to do is we're going to be studying a problem similar to the previous problem that we solved in the previous video. Understood? The problem that we solved in the previous video was an 8 mark question from compartment 2018, and today we're going to be looking at a 8 mark question again, but from the compartment 2020 question paper. Understood? It has all the adjustments like the previous problem, but if you see how it is different from the previous problem, in the previous problem, we had two people who had defaulted and we had to forfeit the shares of both of them. Whereas in this problem, there is only one person who is defaulted. And in the previous problem, there was no premium involved. However, in this question, we have securities premium. So without further ado, let me read the question right away. A Limited invited applications for issuing 80,000 shares of rupees 10 each at a premium of rupees 4 per share. The amount was payable as follows. On application, rupees 5 per share. On allotment, rupees 9 per share, premium included. Applications were received for 1,40,000 shares and allotment was made to all the applicants on pro rata basis. Money overpaid on application was to be adjusted towards sums due on allotment. So whatever excess application money is there should be utilized for allotment. Rajiv, who had applied for 1,400 shares, failed to pay the allotment money. So we don't know the number of shares that are being held by Rajiv. They only given us the number of applications made by Rajiv. As we have already discussed, the number of applications made by Rajiv will not be equal to the number of shares held by Rajiv when pro rata allotment has happened. He would have got lesser shares than the number of applications that he has made. So we'll have to find that out also, the number of shares held by Rajiv. His shares were forfeited. Later on, these shares were reissued at 9 per share as fully paid. So let's start solving the question. In the books of A Limited and journal. All right. So we have serial number, date, particulars, ledger folio, debit and credit. All right. So, okay. So now the first journal entry is receiving application money. The date is not given. The journal entry for receiving application money, as you all very well know, is bank account debit to equity share application account. And how much is that, my dear children? It's the company received 1,40,000 applications and application money was 5 rupees per share. So 1,40,000 into 5. That is 7 lakh rupees. Once again, I remind you, you use a proper journal entry. You don't, narration. You don't write this application money received. Understood? All right, the second journal entry, as I told you, is the most important journal entry in problems like this. We'll have to allot shares. We have to take the amount that is supposed to be taken to share capital. We have to refund if any applications were rejected. And then the remaining excess application money has to be adjusted towards calls or allotment as it has been instructed in the question. In this question, it says that money overpaid on application was to be adjusted towards sums due on allotment. So we got to take the excess application money to be adjusted against allotment. Understood or not? And there is no rejection in the question. As you can see, applications were received for 1,40,000 shares and allotment was made to all applicants. No rejection has happened in this question. We don't have to refund any money unless and otherwise that excess application money is more than enough to take care of all the amount that is due on all the calls. Understood? So let's do this now. Equity share application account debit. As I told you, the second journal entry, you always debit equity share application with the entire amount that you made, that you received in the first journal entry to equity share capital. Here you got to transfer the application money receivable on the allotted shares, application money receivable on the allotted shares to share capital account. So that is 80,000 shares have been allotted. 5 rupees is the excess, 5 rupees is the application money per share. So that will be 4 lakh. And the remaining amount has to be computed and compared with the allotment money due. It has to be taken to equity share allotment account because the question says that the excess application money has to be adjusted towards sums due on allotment. The excess application money right here is 7 lakh minus 4 lakh, which is 3 lakh. Am I right, my dear children? The allotment money due is 80,000 shares into 9 rupees, 7 lakh 20,000. So the 3 lakhs that we have is not more than the allotment money due. So the entire excess application money can be taken to share allotment account. If the excess application money that we have is not 3 lakh and it is 8 lakh, you cannot take the entire 8 lakh to equity share allotment account because the allotment money due itself is only 7 lakh 20,000. Am I right? So you would have taken only 7 lakh 20,000 to equity share allotment account. Remaining 80,000 should have been refunded. Understood? But in this case, that is not the situation. The total allotment money due is 7 lakh 20, but the excess application money available is only 3 lakh, and therefore the entire 3 lakh has been taken to equity share allotment account. So allotment money made due. Understood or not, my dear children? All right, moving on to the third question, third journal entry. We make the allotment money due in this journal entry. Equity share allotment account debit. As allotment includes premium, we also credit premium share cap. We credit share capital and premium account. So the equity share capital account. Just give me a second. Yeah. And securities premium account. As I told you already, whether there is excess application money or not, you're always supposed to take the entire amount. You're always supposed to make the allotment due for the total number of shares that you're holding. So here you're holding 80,000 shares. Allotment money is 9 rupees per share. And out of that, 4 rupees is premium. See, in the question, they've given that A Ltd invited applications, shares of 10 each at a premium of 4 per share. So the 4 rupees is premium. So that premium portion will be taken to securities premium account, and the capital portion, which is 5 rupees, 9 minus 4 is 5. 5 will be taken to share capital account. Allotment money made due. Again, you write the proper narration. All right. Now we got to receive the allotment money, but there is a problem with receiving the allotment money. The problem is Rajiv, who had applied for 1,400 shares, failed to pay the allotment money. So there is some call scenarios. Now you might wonder, you might think that call scenarios is simple, right, and straightforward because all you have to do is what is multiply the number of shares held by Rajiv with the 9 rupees, and you will get the answer. But that is not true in pro rata cases, right? As I explained in the previous problem. In pro rata cases where there is excess application money available for a particular call, like this, we have 3 lakh available towards allotment. And if there is call scenarios, we have to do the working note to compute the call scenarios, like we did it in the previous problem. And what working note would that be? It is this working note. Working note computation of call scenarios. So as you can see, just give me a second, Madhu. So let's do this working note. We first write down the excess application money available per share, and then we write down the allotment money due per share, and then we compare them both to find out the allotment money receivable. We multiply that with the number of shares held by the person who's defaulting to arrive at the calls in arrears. There is a small change in this working note, my dear children. This basic structure is changed, but whenever there is premium involved, what I want you to do is divide the allotment money due into share capital portion and securities premium portion. Understood or not? And the allotment money receivable also into share capital portion and securities premium portion. I'll tell you why we're doing it, and you'll understand it when we are doing it. Understood? Let's first compute the excess application money available per share. The total excess application money available in this question is 3 lakh, my dear children. This 3 lakh is available for how many shares? For 80,000 shares that we allotted. Am I right or not? The total excess money application money available is 3 lakh divided by 80,000, which is 3.75, my dear children. The allotment money due per share is as share capital rupees 5 per share is due, and as securities premium rupees 4 per share is due. So the excess application money can be used against what? First against share capital, then against premium. So share capital out of the 5, 3.75 can be set off against the 5 because that is available as excess application money. So how much share capital are you supposed to receive? 5 minus 3.75, which is 1.25. There is no excess application money available for securities premium portion because you only had 3.75 and that itself was set off completely against share capital, and even then we had to receive a certain amount of capital. So the remaining 4 has to be received. So money receivable on allotment per share is 5.25 rupees, my children. And our friend did not pay this 5.25. Now, how many shares are being held by our friend? Is it given in the question? What is given in the question? Rajiv, who had applied for 1,500 shares, failed to pay the allotment money. So they only given the number of shares applied by Rajiv. They have not given the number of shares held by Rajiv. Am I right or not? 1 second. Yeah. So in order to find that out, what are we supposed to do? We multiply and write the applications, and below in the denominator we write the total number of applications on which pro rata allotment was made. In this case, it happens to be 1,40,000, and in the numerator we write the total number of shares that was allotted on pro rata basis, which happens to be 80,000. So you cancel this. What you get is 800. Am I right? So Raji basically has 800 shares. Understood or not, my dear children? So now we got to account for this 800 shares. That is the number of shares on which calls and arrays has happened. So it is 800 into 5.25. Understood or not, my dear children? The total calls and arrears of Raji will be 800 into 5.25, which is 4,200. So the journal entry here, the fourth journal entry would be receiving allotment money, right? And there is some calls and arrears. So bank account will be debited. Calls and arrears account will be debited. To equity share allotment account. Now, as I've already told you that every time you receive a certain call, you got to make the entire amount due. You have to credit the entire amount due to the call account. Am I right? But if there is excess application money, what do? We take the amount due and we subtract it with the excess application money available. That is 7,20,000 is the total amount due on allotment. We subtract it with 3 lakh and we credit 4,20,000. Understood or not, my dear children? Out of that, we have computed that the false and arrears is 4,200, and therefore the amount received in bank will be the balance in figure, which is 4,20,000 minus 4,200, which is 4,15,800. Understood or not, my dear children? What we need to do next is forfeit the shares of Raji, because there is no first call in this question. So we just have to go ahead and forfeit the shares. And the journal entry for forfeiting the share is, whenever premium is involved, the journal entry for forfeiting the share is what, my dear children? It is Securities premium account debit, share capital account debit to share forfeiture account and to calls in arrears. Rajiv's shares forfeited. Now, securities premium will be debited with what? It will be debited with the total number of shares forfeited multiplied by the total number of shares, amount receivable as premium on each share. The amount receivable on premium on each share was rupees 4, and none of that 4 was received. As you can see, Rajiv did not pay allotment money, and the excess application money was only enough to settle share capital. The entire securities premium was receivable, which was not received, and therefore 800 into 4, which is 3,200. And share capital will be credited with what, my dear children? Give me one second. Share capital will be debited with what? It will be debited with the number of shares forfeited into called up value of capital per share. And the full amount has been called up in this question, and therefore it is 800 into 10, which is 8,000. And we've already computed the call scenarios. It is the amount that we have debited to call scenarios before in the previous entries. In this case, there was only one entry in which we used call scenarios and we are receiving allotment money, and that was 4,200. We have credited that. So what will be your share forfeiture? It will be the balancing figure. So 8,000 plus 3,200 minus 4,200, which happens to be 7,000. Now these shares have also been reissued. The terms of reissue is clearly given in the question. Let's look at the question. The question says that later on, these forfeited shares, all of the forfeited shares were reissued at rupees 9 per share as fully paid up. So all the shares have been reissued at rupees 9 per share as fully paid up. Only when there is partial reissue, you got to do a working note for the computing the profit on reissue. When all the shares are reissued, you don't even have to do any working note to compute the profit on reissue that has to be transferred to capital reserve. Anyway, first just reissue the journal shares first. The 10 rupee shares have been reissued for 9 as fully paid up, which means what? We have given a discount of rupees 1. Understood or not, my dear children? So 10 rupee shares, we have taken 9 and we have agreed that it is fully paid up, which means we are giving a discount. Whenever we give discount, the journal entry is bank account debit, share forfeiture account debit to equity share capital. So shares reissued. What will be the amount that has to be debited? All the shares have been reissued. So 800 shares have been reissued for rupees 9. So bank will be debited with 800 into 9, which is 7,200. And we have given a discount of 1 rupee per share. 10 rupee shares have been reissued for rupees 9. So 1 rupee is a discount given per share. So that will be 800. And it has been reissued as fully paid up. So that will be 800 into the face value of the shares. When they say fully paid up, you credit the share capital account with the face value of the shares. The next journal entry would be to compute the profit on reissue and transfer it to capital reserve. But we don't even have to compute it here because of fact, when all the shares have been reissued, accounting for capital reserve was very simple. It is whatever is credited into share forfeiture account in the forfeiture entry minus whatever loss on reissue was debited to share forfeiture in the reissue entry. That will be your profit on reissue. Only when all the shares have been reissued. If there is partial reissue or if there is reissue on variable terms to two different people, then this will not be true. You'll have to do the working mode. But in this question, as all the shares have been reissued to one person, we don't have to do any working note, we can directly compute profit on reissue. So how do you do that? The amount credited to share forfeiture account 7,000 minus the loss on reissue 800. So that will be 6,200. Understood or not, my dear children? With that, we have come to the end of this problem. As you can see, it's very simple once you know how to solve the problem. If you didn't understand, kindly go through the solution once again. And in case you didn't understand even after that, kindly do give me a comment below this video so I can explain whatever doubts you have. Understood or not? Just give me a second. I'll show you the solution from the previous year, from the board that was given as a suggested answer. So this is the solution, my dear children. I hope you can see it's a little small. Kindly excuse me. Next time I'll show a bigger image. So as you can see, bank to equity share application 7 lakh, equity share application to equity share capital 7 lakh, 4 lakh, 3 lakh. And each of these journal entries have 1 mark, if you notice. And this is the entry for making allotment due. This is the entry for the call scenarios. We computed it as 4,200 correctly. And this is the entry for forfeiting the shares. Again, we did that correctly. And this is the entry for reissue of the shares, which we did correctly. And this is the entry for transfer to profit capital reserve, which also was done correctly by us. All right, children. So with this, we have come to the end of this video. We'll come back and meet you with another problem tomorrow from the previous year question paper from the chapter accounting for share capital. Till then, you people take care, have fun, keep studying, keep working hard. Bye.